I'm Kristin McKenna, and I'm a certified financial planner at Darrow Wealth Management. What happens to restricted stock units or stock options after a public company merges with or is acquired by another public company? Well, what could happen will depend in part on whether your options or awards are vested or not. In these situations, you will want to review the terms of your company's equity incentive plan, which you likely received with your initial grant. This document, as well as the M&A agreement, will include specifics on how existing shares and equity compensation packages will be handled. If you have vested stock options that haven't been exercised, or if you're an existing shareholder from vested restricted stock units or options, there are three most probable outcomes for your shares, awards, or options. The first is that shares could be cashed out, which would liquidate your equity position. Now, shares could be cashed out for a number of reasons. For example, if the acquiring company doesn't offer any sort of equity compensation to its employees, then it likely won't want to extend that option to employees of the acquired firm. Also, if employees of the acquired firm likely won't be hired by the purchasing firm, that's another reason to cash them out. And finally, if the deal was all cash versus an all stock or combination of cash and stock deal, that's another reason that they may want to liquidate the existing shareholders of the acquired company. The second option is that your shares or options could be assumed as is by the acquiring company. Now, the acquiring company may do this to avoid diluting its own shares, or perhaps they want to keep the shares of the company that they're acquiring intact and continue to list it on a public exchange. The third way is that shares of the target company may actually be substituted for the acquiring company's stock. The original grant agreement and the M&A agreement will certainly include details about what could happen in the event of a merger or an acquisition, and the valuation details in the M&A agreement will certainly be subject to the terms of the deal as well. Now, after the news of the merger or acquiring becomes public, the market will react and the stock price will move in either direction, depending on how the market views the deal and what the expected synergies are between the two firms. If you have unvested options or restricted stock units, there are a number of things that could happen as well. And in addition to all of the potential options that we just discussed, unvested options or awards could actually receive accelerated vesting upon change of control, which would just speed up the vesting process. But they could also be canceled. This is, of course, the worst case scenario, and although it doesn't happen very often, it is a possibility. You'll really want to review your company's equity incentive agreement as well as the M&A agreement once it's available. If your employer is merging with another company or being acquired, it can be a really scary time and raise questions about your job security. At Darrow, we frequently help new clients and existing clients navigate a job transition and assess their equity compensation package. If you would like to learn more about our wealth management services, please visit our website and schedule an introductory call.